Hey, my name is Shane Arona, and I'm going to be presenting the case of Gilbert versus the 2010. A bit of overview of this presentation is an intro and background to the case, the facts of the case, the issue that lies within the case, the decision and reasoning, and then the implications on practitioners in today's tax world. I'm also going to provide a reference slide at the end of this presentation. So a bit of intro and background to the case is that defining as it is vital to classify the income derived. A business includes any profession, trade, employment, vocation or calling, but does not include occupation as an employee. This is found in the Income Tax Assessment Act 1997, Section 995. Purposes that if the activity of the taxpayer is considered of business nature, and the proceeds of sales will be accessible as ordinary income, and the taxpayer will be able to claim the deductions involving expenses incurred to fund the business. However, in contrast, that if the taxpayer's activities is merely a hobby or pastime, then the proceeds and the taxpayer will not be able to claim deductions for the expenses incurred to run the business. So the facts of the case we have for Gilbert versus the Federal Commission of Taxation is Brett Gilbert, the taxpayer, was the managing director of a company, Aircom. In 2004, Gilbert had discussions that stated that he was developing in his mind money of what he... In 2005, Gilbert's racing past and keen interest led him to conduct a motorcycle and sidecar racing activity as an intended business. Showing his keen interest for his business, in the periods ending 30 June 2005, in 2006 and 2007, Gilbert had claimed notable deductions in these year ends in regards to what he claims is a business associated with his motorcycle and sidecar racing. In 2008, the Commissioner had issued a notice of assessment to the taxpayer for 2007, disallowing his business deductions he claimed, as well as he issued a notice of assessment for the year 2005 and 2006, disallowing the previously accepted deductions that happened in 2005 and 2006. Gilbert had then objected to the Commissioner's assessment and had sought review through the AAT. The issue for the case is, during the 2005, 2006 and 2007 period ends, was Gilbert carrying on a business through his motorcycle and sidecar activities, or was it merely deemed a hobby or pastime? So the decision and reasoning behind the case is that it is noted that it's definitely a complex case in regards to classifying Mr. Gilbert's business. So if the issue had been decided in Gilbert's favour, then it must be considered to have satisfied the two tests in Division 35 of the Income Tax Assessment Act 1997, which is non-commercial losses. He then must have to satisfy the two tests under Section 3530, which is the assessable income test, and the other assets test in Section 3545. But the business in question for Gilbert lies within the Ferguson and Federal Commission of Taxation case in 1979. This case states that not one factor is decisive and many factors have to be considered. These factors are weighed up to determine whether the taxpayer is carrying on if he is just merely pursuing a hobby or pastime. In contrast with the hobby, how vigorous the pursuit may be, it does not usually amount to carrying on a business, and then the intention to derive income from an activity doesn't mean the taxpayer is carrying on a business. The factors were against Gilbert that his approach to his activities were not of reasonable level of organisation and system, and his unsatisfactory bookkeeping creating uncertainty for his revenue and expenses, and, in summary, his activities were not methodological as a competent businessman. Therefore, it was concluded that the taxpayer, Mr. Gilbert, had failed to satisfy the business definition in the relevant years. Instead, his motorcycle and sidecar racing activities was described as a vigorous pursuit of recreational activity or hobby. In these circumstances, the objection decisions must be affirmed. Therefore, Mr. Gilbert's objection was lost. The implication on practitioners in today's world is that the Gilbert v. Federal Commissioner of Taxation case outlines the issues practitioners must consider in the modern day tax system. When dealing with the classification of income from a business, it is important that the relevant factors are taken into consideration when undertaking a business. Tax practitioners must weigh up these relevant factors of repetition of transaction, commercial nature of activities, size and scale of activity, profit motive, and system and organisation. These factors are demonstrated in the Ferguson versus Federal Commissioner of Taxation case. However, not one sole factor is determinative. Practitioners must take into account the consideration of all factors and then create a balance to determine if the taxpayer is really carrying on a business or not. Practitioners must then understand the scope of the business, determining whether receipts are outside or inside the ordinary course of business, as not all receipts are income in nature and some may be capital receipts. These receipts can be deemed as extraordinary transactions, meaning that they will occur outside the ordinary course of business undertaken by the taxpayer, therefore will not be assessable, as demonstrated in Western Gold Mines versus DCT, the Federal Commissioner of Taxation versus Whispered Speech. All these cases of Ferguson v FCT, Western Gold Mines v DCT, and FCT v all impose business income. So now we finish off with a reference slide, and I would like to thank you for listening to my presentation.